So now that we have some understanding of how banks operate, let's try to see how we can learn to identify whether or not a bank is successful. A simple case study will involve the comparison of JP Morgan, which is widely regarded as one of the world's best banks, compared to another major bank, Citigroup, which apparently have had a weaker performance over the last decade. Since July 2012, JP Morgan has had a 217% increase in its share price, while Citigroup has had a meager 75% increase in its share price across 10 whole years. Given the consensus that the stock market is a fair weighing machine in the long term, this video will try to explore why there are such big differences in their valuations, and will entail the use of commonly used financial ratios and metrics that are used for banks. All companies, including banks, need capital to run its business. Capital is broadly defined as anything that entails a benefit or useful purpose to its owner. For non-financial companies, capital can be acquired through two main ways. The first method is through issuing debt. This comes at the cost of having to repay interest rates at regular intervals. The other method of acquiring capital is through equity, which entails issuing shares to the public stock market or to private investors, which has its cost in giving away part of the ownership of the business. With banks, however, the choice of whether or not debt should be classified as equity is debatable. For most non-financial companies, debt is used as capital in order to purchase and invest into new equipment and properties in order to expand their business. But for banks, debt comes in the form of deposits from everyday people like you and I, which is used to directly fund the loans that the bank makes to others, rather than being used to invest into other things. This makes debt to banks similar to what wood is to IKEA. It is raw material that is used to fund regular operations and not used for investments. With that in mind, it is then commonly accepted that the capital for banks solely comes from its equity. The equity of a business is calculated by taking all the assets in the company and deducting all the liabilities from it. This is also known as the book value of the company. In essence, this is how much of a business is left over if it sells all of the assets that it has in order to repay all the liabilities that it has. However, not all of the assets in a company can be sold. This is because there are intangible things such as a brand name for Coca-Cola, which although provide a lot of value for their respective companies, cannot necessarily be sold off to someone else. Analysts account for these by deducting these intangible assets from the equity, and the final value is known as the tangible equity. In the case of banks, the rights to the assets and the liabilities are not limited to just the common shareholder. There are also others such as the preferred stockholders that are typically owned by private investors or government institutions. From our point of view as common shareholders, we want to know how much of the pie actually belongs to us. This leads to the calculation of the tangible common equity, which is tangible equity after the removal of the equity that does not belong to the common shareholder. This graph shows the common shareholder equity for both banks over the last decade. As we can see, JP Morgan has done better in terms of increasing the total amount of equity that is available to its shareholders, whilst the common shareholder equity for Citigroup has seen a massive decrease in 2017 and has stayed relatively flat since. When looking at the percentage change year over year in the shareholder equity, we can again see the shareholder equity has been increased every single year, but this cannot be said for Citigroup. The amount of business that the shareholders own are not just determined by the number of shares that they own, but determined by the percentage of the total number of shares that they own. If a company increases the amount of shares outstanding over time by issuing new shares, this can lead to a decrease in the profits or the equity per share as it is being diluted down. Mature companies and many banks utilize this mechanism by conducting share buybacks. By buying back shares that are in the open market, there are fewer shares outstanding, which means the same pie is being divided by a smaller number of shares, which is one way companies can enhance shareholder value. So, if we look at the tangible book value per share for both banks, we can see that both banks have managed to consistently increase their book value per share. When we compare the tangible book value per share to the total equity from the last graph, we can see that despite the total equity decreasing for Citigroup over the last few years, the book value per share has been increasing because Citigroup has been conducting more buybacks. And when we look at the change in the book value per share for both banks, we can see again that JP Morgan has had more years where there is a larger percentage increase in the book value per share. Other than looking at the size of our share of the pie, it is important to also look at the returns generated by the bank. The net income is a simple metric that reflects the amount of money that the bank has earned after deducting all of its costs and taxes on paper. This graph shows that JP Morgan has been a clear winner under this metric, whilst the net income from Citigroup has shown little growth over the last decade. Unlike other industries, the net income in banks are generally more volatile and more sporadic. This is because there are times when borrowers are suddenly unable to make their repayments for their loans, which can lead to major losses for the banks for a given year. Banks try to smooth out these fluctuations by making predictions ahead of time on how many of those loans it won't be able to collect in a given year. These are then accounted for in the provision for credit losses or loan losses that are in the income statement for the banks. Because these provisions will heavily affect the net income that is received by a bank, a more conservative bank will have a higher provision for loan losses and will therefore have a lower net income, whilst a more aggressive bank will make a smaller provision, which results in a higher net income. Other methods of evaluating the profitability of a bank can be measured by comparing the returns of a bank with the assets and common tangible equity. This can be seen as how well the bank has been able to generate its return, given that each bank has different amounts of equity. Using these metrics, we can see that JP Morgan has again been able to generate better returns based on its assets and its common tangible equity for every single year in the past decade. Another popular metric is the efficiency ratio, which is calculated by dividing the non-interest expenses of a bank by the net revenue that it has generated. What this metric shows us is that for every dollar of revenue that the bank has received, how much of it is gone to pay off the costs that are required to maintain its operations. The lower the value, the less the bank has to spend in order to generate every dollar that it has earned, and the more profitable it is. Using this ratio, we can see no obvious winner between the two banks, although Citigroup has had their efficiency ratio starting to creep up in the last 2 years. Since the financial crisis, big banks have been under much greater scrutiny to maintain healthier balance sheets to prevent the recurrences of the financial crisis. These new regulations include the Common Equity Tier 1 ratio and the Tier 1 capital ratio. These ratios reflect the amount of capital which we have already assigned as the value of the equity relative to the risk-weighted assets in the bank. The term risk-weighted assets refers to the fact that different assets owned by the bank carry different amount of risk that it will lose its value. For example, a US government bond can be seen as having zero risk and therefore will not be included in the risk-weighted assets. On the other hand, a mortgage-backed security, which is one of the culprits of the financial crisis, has a high risk of being defaulted on and will be included in the calculation for the risk-weighted assets. The implementation of a Common Equity Tier 1 or Tier 1 capital ratio ensures that the bank has sufficient capital to absorb any unexpected losses during the normal course of a bank's operations. If banks do not maintain adequate ratios that are set by the regulatory authorities, they will be subjected to harsher terms, such as not being able to give out dividends to its shareholders. So a higher ratio not only indicates a safer bank, but it also gives the management team more flexibility to enhance shareholder returns. As of June 2020, the Federal Reserve has set the latest requirements for these two banks, with JP Morgan's Common Equity Tier 1 requirement set to be 12% and Citigroup's at 11.5%, up from 11.2% and 9.5% previously. Based off the metrics that we have looked at, JP Morgan does seem to be the better run bank over the last decade. Though the differences in some of these metrics may seem to be insignificant, a 0.7% difference in the Common Equity Tier 1 ratio can equate to a difference of tens of billions of US dollars in common equity. The superiority of JP Morgan has already been reflected in the better performance in its share price. Because the equity is such an important metric for banks, one may look at the price to tangible book value ratio to see how much investors are willing to pay for the stock. At the moment, JP Morgan is trading at a 3 times higher price to tangible book value ratio compared to Citigroup, which reflects on the higher expectation and trust that investors have on JP Morgan. This comparison has relied on simple financial metrics that are relative in nature. It has not taken into account the fact that these two banks have different proportions of their different types of businesses which entail different risks, nor has it attempted to calculate the intrinsic value of these businesses. A more in-depth analysis would compare these two banks based on the different operating segments that they have, as well as the riskiness on the loans and other financial products that it is selling to its customers.